Greetings traders, this is Longshot with part 2 of my technical analysis series, and it's all about indicators. For the benefit of those who are brand new to trading, I'll start with defining what indicators are. It's quite simple really. Here's the price on a blank chart, shown in the best format for analysis purposes, which is candlestick. Each candle covers a fixed time period, in this case days, and shows each day's open, high, low, and closing price. Volume is usually referred to as an indicator, but it's actually part of the price data, representing the number of items that changed hands, in this case shares, during each day. So an indicator is anything else added to the chart that's calculated by an algorithm. I'm using the freely available TradingView website here, and as you can see, it offers scores of them. It also has a bunch of predefined templates set up for you, each with their own mix of indicators, and I'm just rolling through a few of these here so you can see what they're suggesting that you do. Have you ever stopped to ask what the actual point of all these indicators and templates is? What are they supposed to accomplish? I can put it in a sentence for you. They're supposed to provide the context and rules for entering, managing and exiting trades. That's all. Their effectiveness can therefore be directly measured by whether or not they actually do help traders get into a high proportion of profitable trades, and do so better than trading systems that don't rely on indicators at all. If you've been trading for a while and you use indicators, have you ever stopped to assess just how well those squiggly lines are actually helping you? Or whether they're actually making it more difficult to read a chart, to trade, and they backfire on you more often than you're liking? This video is intended to help you do just that, and to show new traders that a search for an indicator-driven trading system is very likely to be futile, costing you not only money, but considerable time as well. Here's a famous saying in the trading community: 95% of all traders fail. Now, I don't know how true that is, but from what I've seen, I'd agree, most traders do not make consistent profits. Let me hit you with another saying, and this one isn't famous because I'm making it up, but it matches my experience. Most traders rely on indicators. Now, correlation doesn't prove causation, and there certainly are other factors that cause traders to fail, quite a lot of them, and that's a whole topic for another video. But one thing is clear to me: indicators are no help to struggling traders. So why do people use them? Let's go through a list of common excuses and see if any of these resonates with you. As I showed you, charting platforms offer a wide array of indicators these days, templates already set up for you, so it seems natural that you'd use them and not question it. If that's you, it's time to put on your thinking cap and start questioning things. Yes, most indicators were designed decades ago by mathematical geniuses, so they must be good, right? If you believe that, I suggest you go back and watch the part 1 video again. This one's a sure indication that you're using them as a crutch. You know, there's a reason why trading without indicators and reading the price directly is called naked trading, because you'd feel naked without those indicators. Feel free to Google that term, naked trading. I'm not making it up. If you stick with me throughout this series, you too will likely become a naked trader, as indeed I am. And aren't you glad now that I'm not using a web camera to record this video? Yes, if all the people I know use indicators, they must be the way to read charts, right? Don't follow the herd, people. The herd's usually wrong when it comes to trading. Remember that 95% figure? Think these things through for yourself. You may have heard the saying, do your own research, and it applies to more than just researching companies. It applies to chart analysis and trading systems as well. Ah yes, the disciple blindly copying the guru. I see this so often. And they don't really understand what the guru is doing because they rarely ever explain things in any depth. If the guru did, they'd likely lose their following, either because people don't need them anymore, they can do it for themselves, or because the guru's method has been shown to be ineffective. If you've watched the part 1 video, you'll have seen my warnings against blindly following anyone. You have to use your own brain and make sure you understand everything for yourself. So, looking at this list, there is one overriding reason that sums up all of them. People who think in these ways are showing that they have no real idea what they're doing. It's that simple. While I'm making lists, here's another one. You know I have very little faith in indicators. Well, here are my reasons. Every indicator is derived from the price. Sometimes the volume too, which is just another part of the price. Therefore, everything an indicator tells you can be read by observing the price directly, once you've learned how. It's logically impossible for an indicator to tell you something that isn't already there in the price itself. Every indicator tries to simplify the price movements in order to highlight certain aspects of it. And this in theory can be a good idea, if those aspects are actually valuable to you as a trader, and the indicator adapts to changing market conditions. However, that's just it. Indicators don't adapt. They can't adapt. They're fixed algorithms, which means they regularly give unreliable signals. They can't tell the difference between when the price is stuck in a small fixed range or setting off on a strong trend. They get it wrong far too often. And there are far too many of the damn things. Choice is great, but to properly evaluate every indicator or indicator combination would take a lifetime. Yep, indicators are dumb. As I said, they're fixed mathematical algorithms. They really aren't very complex. It's not as if these things are artificial intelligence. Far from it. And lastly, yes, indicators obscure the price itself, making it harder to read and encouraging the trader to focus on what the indicators are doing instead. Remember, you're not going to make money if you correctly predict a rise in a squiggly line. You make money if you correctly predict a rise in the price. One last thing before I move on. I've mentioned the words trading system a few times already, but a surprisingly large number of traders don't seem to have actually sat down and formalized their rules for trading. They don't even see the need for doing so. But like it or not, if you're trading, you are indeed following a system, even if you're not aware of what it is. If you're going to trade successfully, you need hard and fast rules. That's what separates professional traders from amateurs. Okay, enough with the boring PowerPoint slides. It's high time I started focusing on indicators. So let's bring up a chart. All right, so we're looking at, what is a Commonwealth Bank daily chart, the last year or so, 2 years or so of data. And you can see it's a bit confusing to look at. Sometimes charts are simple without any, just looking at the price alone. Sometimes they're complex like this one is. So a lot of people would look to add indicators to try and help make sense of this so that they can trade it. Let's just start off with the very simplest of indicators. It's the moving average. It's basically at the heart of pretty much every indicator, or most indicators, have got moving averages built into them. So it's a foundational kind of indicator. I'll give it a longer period. Explain why in just a second and make it a bit thicker so we can see it. Right, now I've got that set to 50 days. I can set it to whatever length I like. There is no magical value here, and that is the same for every indicator as well. All of them have values which you can adjust, and so what looks like, well, this is the indicator, suddenly it can be something else if you just give it a different value. So at the moment 50 means the last 50 days is averaged to make up what the value of the line is at any individual point in time. And because it's a moving average, a rolling average like that, that means it'll lag behind price movements, as you can see. It's not predictive in any way, shape or form. It trails behind. It does smooth out the movements in the price. You haven't got all the noise, you've just got a nice smooth line. But because it moves after the price has already moved, the movement of this line can be too late. You can see it turns down there. The price is already way down here. Its movements are already almost done. So as an indication of trend, it's okay, but it's not great. And if you shortened the period to try and make it respond more quickly, then you just starting to have it wiggle around with the price. So its value as a trend indicator declines. The other thing that this indicator can be used for is to look for support and resistance with the price bouncing off it. And as you can see, by and large, the price is ignoring this line. I mean, the market will do what the market wants to do. The market doesn't move because an indicator says something or other. Indicators are just trying to calculate a value based on what the market's doing, but the market is its own beast. Indicators don't drive the market. The other way round is more the truth. The market drives the indicators. So what can we do here? We can add another one. Okay, this one is a 200-day moving average, and this is one that's pretty commonly used traditionally for many analysts Doesn't mean they're necessarily right, but at some point in time, the 200 moving day, the 200-day moving average was given some kind of special significance. Not that it should have it. Now, what can you do with two moving averages on a chart? Well, if one's beneath the other, you can say, well, we're in a downtrend. You should only look to go short and not long. Okay, and when it crosses above it, that's called a golden cross. We're now in an uptrend. You can look to go long. Okay, death crosses when it crosses below. Now you look to go short. Only trouble with that is, if we ignore the indicators there, we basically have a ranging price here. It's going up, it's going down. There is no real trend here. There were some really good long trades you could have taken here when it said only go short. And there were some good short trades you could have taken up here when it said only go long. So the indicator is not necessarily helping us a great deal. It's great when the price actually trends, like back here. There was a nice sustained uptrend, and it said, okay, keep going long, and it kept you in the trend. That's great when there's a trend, but often the markets don't want a trend. Okay, and when there's a trend, do you really need the indicator to tell you should go long? I'm not sure. Furthermore, it gave a nice false signal here. That was a really golden opportunity to go long. But this crossed over and said, no, it's a death cross, go short. Get out of your long trades. Bad idea. Okay, let's look at a variation on the moving average. It's the Bollinger Band. I see a lot of people using this on their charts. It beats me why, to be honest. So let's discuss it. We have a moving average in the middle. It's a 20-period moving average by default, as with the other one. You can change that to whatever you like. The bands on each side are the standard deviation of the price from that moving average multiplied by 2. And that's enough to usually encapsulate the price within the bands, except for when it really wants to move quickly. Here it's pushing outside the bands and the band's struggling to keep up. What is the use of this, you might be asking? I mean, could you say go long whenever it's been pushing the lower band and crosses up above? You could, but you'll have some situations where it then turns back on you. Every different type of trade you could think of, or signal you could think of based on the Bollinger Bands, will give you a lot of false signals. Really, this indicator, it's used so much, and I've done a lot of testing with this indicator over time, trying to find out what it can be used for, as I have with many other indicators, and I have not found a use. If you know a use of this, then I would advise you to test it, but more on that later. Here is another type of indicator. This is the RSI, or Relative Strength Index, which I discussed in the first video, and it's one of a class of indicators called oscillators. Other common ones are the CCI, which is the Commodity Channel Index. MACD is also commonly used, as is stochastic, and there are a whole bunch of others which are less common. But most of them have very similar characteristics. Firstly, they look for what's called overbought and oversold states in the market, and the other thing they can do is look for divergence. I'll start with overbought and oversold first. The idea of overbought is when the price gets above, or rather the indicator gets above this top line. Oversold is the opposite, it gets below the bottom line. All it means is that the price has moved fast enough and hard enough to push the indicator into that state. And the idea is that once it's gone into that state, you can trade the other direction when it comes back, and you'll get a good trade out of it. And sometimes that works. You can look back here though. When the market is wanting to drop, it doesn't work. Oversold here, if you went long, you would basically cover a break even if you were lucky before it went down much further. And that's the trouble. Overbought and oversold do not respond well when the market wants to trend hard. Look here where it's going up in a consistent uptrend. And look at all the overboughts. Sorry, I keep getting them mixed up. Look at all those overboughts. And the market took absolutely no notice of them whatsoever. It just kept going up. Now imagine if you're using oversold as an entry point to go long. I see a lot of people doing it. And imagine we're in a downtrend like that. You keep seeing oversolds and say, now's the time to go long, and it just keeps dropping. That's how it can trick you into a lot of bad entries, because this isn't responding to changes in market conditions. It's a fixed algorithm saying the same thing no matter what the market's doing. It is dumb, as I said indicators were. So sometimes it'll work, other times it won't. Furthermore, let's look at this uptrend. what did we have? We had a long entry here. And what's your exit point? Is it when it goes overbought and comes back, in which case you'd be out here? Nice little trade. There's no more oversold entries until here. You missed this whole trend. Unless you have some other means of saying, where do I exit? But even then you would have been challenged because you entered here and the price went into profit and came right back and tested you. We get one tiny little oversold entry there to say go long, another tiny one there, another one here. But otherwise, the price can trend a long way and not even give you an entry, as you can see. So is it really the best way to enter into trades? I'm not sure, particularly as it, like other indicators, can give you false entries when it doesn't actually want a trend. Look at this period where it's ranging here. It doesn't actually quite get oversold at any point, and there are a lot of little entries you could have made, including this one that ran quite nicely. I think I've said enough, you get the idea, but there's one more thing I want to show you with the RSI, which might help demystify how these indicators work. Okay, I have added a 28 period moving average. The RSI is a 14 period, so I've just gone double. And this will help explain what's going on. If you had a line across the middle of the RSI, imagine that is the same as the price visiting the moving average. Let's compare it. In the middle at the bottom on the RSI, and the price is visiting the moving average. It goes away from the moving average, the RSI drops. Can you see what I'm saying? Whenever it comes back to it here, RSI comes back to the moving average. They basically, this is all this is showing is the price moving around this moving average. Nothing more, nothing less. The other way to use the RSI is with divergence. Just select a better line color. How divergence is meant to work is, if the price keeps, say, running up and sets higher highs, but the RSI starts trending down on the peaks, like that. See the price is setting higher highs. That is what's known as bearish divergence, and you can expect the price to drop, as indeed happened here. Does that always work? No. It is another unreliable indicator. There are plenty of times you can point to where it does work. There we are. Oops. Another example of bearish divergence. But there are occasions when there is no divergence. Here, there's a low and then it starts going up without having any kind of divergence set. So if you were looking for divergence before entering a long trade, you wouldn't get it there. No divergence on any of these here. You would not be going long if you're filtering your trades by looking for divergence. Here's an example. That's dropping there, and this is rising. So we have bullish divergence. But again, if you've gone long, tough luck. Price isn't going to go up. Price doesn't respond to what these indicators are saying. Price does what it wants to do. So what does this divergence actually mean? Because some people swear by it. All it means is that the trend is slowing down, allowing the moving average to catch up. Let's compare here. Look at the bottom, that's where it's really oversold. We're a long way from that lagging moving average. Here, the price has actually slowed down, gone sideways for a bit, so the moving average is able to keep up. Even though we set a lower low, it shows as a higher low here because it's closer to the moving average. That's all it is. There's nothing to say that it couldn't just then get some more steam up and start running again, and that's the problem with looking for divergence. And those two things, divergence and overbought, oversold, are used in stochastic, in CCI, and a lot of oscillators. Okay, here's the MACD, and you'll notice what's different with this is there are no top and bottom lines. Okay, all that's happening with this one is it's showing a few moving averages and showing when they cross each other. You could read exactly this information that's on the MACD by putting a 12 period, a 26 period, and a 9 period moving average on the chart itself. Showing it down here so it's separate from the price might make it easier to read. But we've seen how effective moving averages and moving average crosses are. They lag behind the price. They really don't help you. We've seen how effective divergence is. This shows divergence, exactly the same as the RSI did, and just as effective or non-effective as what the RSI is. So what do a lot of people do? Every indicator gives you false signals. You can't rely on any one indicator to show you when and where to trade. So a lot of people's response is to do what's suggested in this particular template here, and that's to add a whole stack of indicators, oscillators and other things on the chart as well together, and try to pick out when they're all saying the same thing and say that's when I should enter a trade. But there's a flaw with that. As none of these indicators are perfect, far from it, what's to say that they should filter out each other's weaknesses and only show you when they're actually saying the right thing? It's just as likely that they'll filter out each other's good signals and only show you where they all agree on a signal that's bad. Adding a whole stack of faulty things together and expecting a perfect result is flawed thinking. It does not work, and it leads traders into indicator hell, spending ages looking for that perfect combination of indicators that gives them a holy grail trading solution. Trust me, that does not exist. I know. I spent years in the past looking for such a thing. I've been there. I know what it's like. You don't have to go there as well and prove through your own experience what I've already been through and others have been through before you. There's one last indicator I want to briefly cover. It's very different from the others in its appearance, and that's the Ichimoku. This advertises itself as a one-stop trading solution. It's supposed to be a complete trading system in the single indicator. And yeah, it looks like a pig's breakfast, especially when you're zoomed out. So let's zoom in so we can try and make sense of what this is telling us. Firstly, we have what's known as the cloud, this shaded in areas between these two moving lines. That is supposed to act as dynamic support or resistance. The color of the cloud really doesn't matter that much. But the idea is we're trying to pick up cases where the price visits the cloud, bounces off it, gives you a trade. In addition, you've got this red and this blue moving average. The blue is faster than the red, so we're looking for a cross of that in the direction we want to trade, and there can be exit points when it wants to come back across it. And we've got this one, the green line, which is, as you can see, it's replicating what the price is doing, but it's lagging behind the price. They deliberately put a delay on it to push it back to the left of the chart. And the idea with that is you would only go with a trade when it's starting to move past where the green line happened to be at the time. Okay, so over here you can see how it's lagged behind where the price is now. So it's not showing you what's in the future. When the price was here, the green line was here, not up here. Okay, that's the idea. The only trouble is, if I zoom out and risk confusing you with all the nonsense of what it looks like when you're zoomed out, you can see it's crossing back and forward across that cloud like crazy. It's no good at all in a situation where the market refuses to trend. I've looked at the Ichimoku for a long time because it does look fascinating. I tried to find ways of trading it. I played around with, again, you can change the numbers that drive this. But again, all that's doing is making it work in some market conditions and not in others. At its heart, despite all its complexity, it's no better than trading based off moving average crosses. It's yet another indicator that promises a lot, doesn't really deliver. And you have to be incredibly careful trading it because you think you're going long with it's bouncing off the clouds here and then suddenly it stabs you in the back. Well, this has been a longer video than I expected. I do hope you found it helpful. On a final note, those of you who watched my part 1 video to the end will have heard me talking about coaching. I did receive several inquiries shortly after posting that video, and my time is now fully booked up. But I would like to help out more people if I could, and in more depth than I'd initially planned with this video series. I expected I'd only be making half a dozen videos at first, and then that doubled, and then I started thinking of all the extra things I could put in the videos, which means it could probably double again. But to do that would take a lot of time. These things take work, to plan and produce. I really can't justify spending that time unless it's paying for itself. Hence, I am considering the idea of making those videos available for $20 a month subscription, and that would allow me to continue producing them in the depth that I really want, and to cover every aspect, not only of technical analysis, but also researching fundamentals, the different basic trading strategies that are out there, such as value investing, growth investing, that kind of thing, entry methods, exit methods, as well as addressing specific questions that viewers might have. I don't like putting things behind a paywall, though. It feels like a bait and switch, and that was not my intention in starting this. As you've watched to the end of this video, I would like your opinion. Would you feel $20 a month would be a worthwhile and fair amount to pay to watch the kind of series that I really like to produce? Or would you prefer that I just kept them free on YouTube and stuck to my original idea of a far more limited series of shorter videos that just lay out the basic principles of how I approach technical analysis? I look forward to your comments on that, as I'll go with whatever you, the viewers, decide is best. But that is all for this video. The next video will be considerably shorter. I'll be looking at how to actually set up your charts in tradingview.com, which is this, and investing.com, which is an alternative, so that you're ready to actually start doing naked price analysis. I hope you'll join me then.